Welcome to our quarterly market update, where we break down what happened in quarter one and what it means for your retirement dollars going forward. So the first quarter was quite the financial journey. The S&P 500 started strong, climbing to an impressive all-time high in February. And investors were feeling optimistic, planning for the future, and then came the tariff announcements. So by mid-March, markets had tumbled into correction territory, dropping over 10% rather quickly, as uncertainty about tariffs rattled investor confidence. The market continued to fluctuate as we approached the April 2nd reciprocal tariff deadline, creating quite a bumpy ride for all investors. But here's where preparation made all the difference. Those with properly diversified portfolios across different regions and asset classes experienced something valuable, which was relative stability during these volatile times. Looking ahead to Q2, we should expect this uncertainty to continue. We'll likely see ongoing volatility as trade negotiations unfold on the global stage. Inflation developments keep economists busy revising their forecasts, and economic policy discussions continue to make headlines. So what's the key lesson? This reinforces why we advocate for long-term disciplined investing. Trying to time these market swings is nearly impossible to do consistently. It's entertaining to watch, perhaps, but not a reliable strategy. So remember, market corrections, while uncomfortable, often represent potential opportunities for patient investors with a long-term perspective. Let's examine this chart showing the S&P 500's annual performance sorted into different return categories. Essentially, the market's historical performance record. So currently, 2025 sits in the negative territory with returns between 0 and minus 10%. But this is where context becomes really important. This chart reveals something crucial that often gets overlooked. Negative years aren't unusual. They're completely normal, occurring about 1/3 of the time. It's simply part of the regular market cycle, like changing seasons. The more encouraging insight is markets deliver positive returns in approximately 2/3 of years. Those are favorable odds, and these positive years are what drive your portfolio's growth over time, even with the occasional setbacks. So, of course, we're only partway through 2025, and there's still plenty of time left. So the market could recover, or conditions could remain challenging. No one really can predict the short-term movements with consistent accuracy. What this quarter has reinforced, though, is a fundamental principle of investing. Success isn't about perfect timing or selecting the next breakthrough company. It's about building diversified portfolios aligned with your long-term goals and maintaining discipline through both favorable and challenging periods. The most successful investors historically aren't necessarily the ones with complex strategies. They're the ones who understand that patience is not just a virtue, it's a profitable approach. The tariff situation has significantly impacted consumer sentiment. Interestingly, while pessimism continues to deepen, Americans are still spending, so their actions don't quite match their expressed outlook. Long-term inflation expectations reached a 30-year high of 4.1% in March, according to the University of Michigan survey. And consumers are anticipating prices will continue rising faster than the Federal Reserve would prefer for the foreseeable future. So what's the silver lining? Several inflation measures are gradually moderating. However, they do remain above the Fed's 2% target, a situation that requires ongoing attention. So the Federal Reserve faces a delicate balancing act. At its March meeting, the Fed revised its economic growth forecast downward to 1.7% while maintaining current interest rates. They're carefully distinguishing between temporary price increases from tariffs and more concerning persistent inflation trends. So the Fed believes tariff effects could be transitory, a technical term meaning these impacts should fade over time. So think of it as differentiating between a temporary disruption versus a long-term structural change. The economic landscape presents an interesting contrast. We have historically low unemployment, rising wages, and relatively solid growth, which are generally all positive indicators. yet interest rate cuts remain on pause. So what's the encouraging outlook? The Fed still anticipates rates trending lower through 2025, which should provide a supportive environment for both markets and the broader economy as we progress through the year. Finally, let's recognize the true standout factor of quarter one: diversification, one of the most reliable investment principles. So while tariff headlines created uncertainty, bonds demonstrated their value, delivering positive returns as interest rates eased slightly. This highlights why a balanced approach to asset allocation remains essential. The first quarter perfectly illustrated diversification in action. Tech stocks, after strong previous performance, experienced a pullback. Energy, healthcare, and financial sectors showed notable strength. Bonds provided valuable stability as stocks faced the challenges they did. And international markets delivered positive returns, reinforcing the importance of global exposure. So what's the fundamental takeaway from quarter one? Market volatility is temporary and constantly changing. What remains consistent is the importance of maintaining a balanced portfolio aligned with your long-term objectives, especially during uncertain periods. So I hope these insights help you better understand current market dynamics and their implications for your financial future. If you have questions about your specific situation, please feel free to reach out. Helping my clients navigate these complex financial environments is precisely why we're here. So before you go, if you found value in this update and you're watching it on YouTube, please consider subscribing. My goal is to build a community of informed investors who recognize that market success comes from sound planning and disciplined execution rather than market timing or predictions. So thank you for your time today.